FX Nation, what's up guys? Welcome back to the channel. Welcome back to another video. And of course, welcome back to Trading with Market Makers 2024 in week 13. Now, we've covered a myriad of different topics throughout the 12 weeks. So if you're new to the channel, do me a favor, go back and watch from the very beginning so that way you are not lost as far as our strategy goes. Also, if you're new to the channel, hi, my name is Mark and I've been trading since 2011, and I'm just here sharing my strategy and my journey along the way to trading. Hopefully you can grasp something from my strategy that could help you in your trading journey as well. So without further ado guys, let's jump right into week 13. So week 13, we're going to be talking about mastering trading psychology. Please make sure that you do not click off this video, because I know a lot of you, as soon as you saw this right here, this topic, you're going to click off the video because you just want to see technical analysis stuff. And probably the reason why you're searching and seeking it is because your trading psychology is not in the right place to begin with. So all you seek is technical analysis and stuff. So I'm telling you right now, do yourself a favor, watch the video and get some actual knowledge that's going to help you in your trading journey. So let's go ahead and start to break down this trading psychology, guys. Now, as a trader since 2011, I've learned that success in trading doesn't come from just mastering the technicals. The most crucial element to longevity and profitability is mastering your trading psychology. Your ability to handle fear, discipline, and emotions under pressure can make or break your trading career. Here are the key psychological challenges I faced as a trader and the methods I use to overcome them. So again, I told you at the beginning of the video to watch the video. And I'm telling you, I'm going to go through exactly what I went through, the things that challenged me the most throughout my career, guys. Let's get started with the first thing. It's pretty obvious. The first thing is FOMO, fear of missing out. Okay? Let's talk about this. So the fear of missing out is one of the most dangerous psychological traps in trading. It happens when you see the market making a big move and you feel compelled to jump in, even though it doesn't align with your trading plan. FOMO leads to impulsive decisions that often end in losses. So how to overcome FOMO? First thing is, stick to your trading plan. Remind yourself that there will always be another opportunity. Trust that your strategy will present the right setups. This is super important, guys. This is why I always stress to you guys about trading plan and why it's so important. Because if you've done the work to create the trading plan, to do your back testing, this right here is going to help tremendously, because you know what the trading plan should produce if you just follow it. Second, planned ignorance. Set alerts at key price levels and walk away from the charts until those alerts are triggered. This prevents you from acting impulsively on every market move. This helped me tremendously when I was looking for specific setups in the market. And so I wanted price action to go to certain areas or certain key levels, whether it was looking for type 3 patterns, continuation trades, type 1s, whatever. And I would set these alerts on TradingView to alert me when price is in the area that I'm looking for. That way I'm not sitting there and literally in front of the computer just waiting and waiting and waiting. It starts to bring out the FOMO. And finally, practice gratitude. Acknowledge that missing a trade is not a loss. Gratitude for the trades that fit your plan will help curb the emotional need to chase the market. So understand that just because you miss a trade doesn't mean you lost a trade. You didn't lose any capital from missing a trade. Tomorrow there's going to be another trade. Next week there'll be more trades. Next month there'll be more trades. So stop thinking about trading as a short-term solution. All right, next, fear of losing. Every trader fears losing money. It's a natural reaction, but letting this fear control your actions can paralyze your decision making. Fear of losing often results in traders exiting trades too early or avoiding trades altogether, even when their strategy says to enter. How to handle fear of losing. Understand that losses are inevitable. Even the best traders don't win every trade. Losing is part of the game, and accepting this will reduce your emotional strain. Guys, listen, you're going to lose trades. It's just going to happen. Every single day, you're going to lose trades. If you take multiple trades a day, you're very likely to lose a trade, and that's okay. You may have losing weeks, and that's okay. All right. The important thing is to have a plan in place for this. And that's why I harp so much on the trading plan. Using a loss diary. Keep track of your losing trades, not just for analysis, but to help you detach emotionally from them. Over time, this will reduce the fear associated with losses. Backtest extensively. When you backtest your strategy over hundreds of trades, you'll understand the normal win to loss ratio. This makes it easier to stay confident when losing happens. Again, journaling and backtesting, two of the things that we've talked about already for several weeks. Okay, I don't keep bringing this back for any magical reason besides the fact that it works. It works. You keep track of every single trade that you make. Okay, especially the losses. When you have enough losses or enough trades of data, you're going to notice the patterns of things that you're doing wrong. But you can't know that unless you have the data to overview. Third thing, impatience in waiting for the right setup. Patience is one of the most underappreciated traits in trading. The urge to consistently be in the market leads to overtrading, which often results in poor trades. Traders must learn to sit on the sidelines and wait for the high probability setups. Guys, one of the biggest lessons that I had to learn for myself is the fact that not every day is going to be a trading day. And once you understand, once you go through enough samples of trades, you're going to know what are the actual trades that you're good at versus what are the actual trades that you're bad at. And you're going to focus obviously on the ones that you're good at. Okay, now those trades that you're really good at identifying and good at trading, that are your actual setups that you should be trading, aren't going to happen every single day. And that's perfectly fine and normal. Okay, so you have to be patient enough to wait out for those specific setups that you know the best. So how to develop patience. Number one, set alerts. Setting price alerts at key levels can reduce the temptation to watch the market constantly and jump in prematurely. Journaling impulsivity. Record the times when impatience caused you to enter a bad trade. Over time, you'll see the damage impatience causes, making it easier to resist. Mindfulness techniques. Practice mindfulness or meditation to stay calm and centered while waiting for the right trade. This helps reduce anxiety or missing out. One of the things that helped me with this is there's a playlist, there's a channel on YouTube that plays very mindful music that just relaxes you. And it's something that I listen to every single time that I'm trading, so I feel more relaxed and I don't feel very, I don't have the anxiety creeping up on me whenever I'm trading. So listen to music while you're trading. So number 4 is fear of a losing streak. Losing streaks are part of the trading process, but the fear of entering one or being in the middle of one can cause traders to either become too cautious or to start over trading in an attempt to recover quickly. How to handle losing streaks. Number 1, focus on process over outcome. Rather than fixating on the losses, focus on whether you're following your process. If your strategy is sound, losing streaks are just part of the statistical distribution. Take a step back. When in a losing streak, consider stepping away for a day or two, or it could be for a session or two. Whatever makes you feel better. It doesn't matter. It could be a day, it could be a session. If you trade the London session, come back for the New York session. This gives you time to reset mentally and come back with a clear perspective. And sometimes, depending on the type of trader that you are, this could mean that you should take a couple of days off, or you should go work out or whatever. Go for a walk, go for a drive, do something. Okay? But the only way to stop the losing streak is to stop trading. Reduce position size temporarily. If fear starts creeping in during a streak, reduce your position size. This will help ease the emotional strain while still keeping you active. This is all in the risk management plan that I talked about a couple weeks ago, I think in week 10 or week 9 in the mentorship. So if you haven't watched the video, or again haven't skipped over that part, go back and watch it, guys. You're missing out on crucial information. Next is fear of being in drawdown. Who likes to be in drawdown? Nobody, right? So drawdowns are normal in any trading strategy, but the fear of being in one can lead to premature exits or even panic. When you fear drawdowns, you might start cutting winners too early, hoping to avoid losses that haven't yet materialized. Oh my goodness. How many of you guys right now, or even when you started trading, got anxiety anytime that you were up, $100, $200, $1,000, and then you were getting a pullback and it went from 1,000 plus, now you're at 200, and you're like, oh my God, what should I do? Should I cut it? Should I get out? Should I get out just to say I won, instead of saying, that I took a loss or something? How to overcome that fear of the drawdowns here. Understand the role of drawdowns. Every strategy, no matter how effective, will go through periods of drawdown. Accepting this reality helps you avoid the panic that leads to poor decisions. Set a max drawdown limit. Define a percentage of your account that you're willing to draw down before reassessing your strategy. This ensures you stay disciplined and avoid emotional exits. This is kind of like just having, if you're in a prop firm, right, and you're trading, they give you max drawdown for daily and then max drawdown for your account, right? These are things that you should also have yourself, okay? You should have yourself a max daily drawdown, also in a max for your capital as well, because your biggest job in trading is to protect your capital. And if you don't have rules set in place for your drawdown, you're not protecting your number one thing that you should be protecting, which is the capital. And finally, scale down your trading. During a drawdown, reduce your position size. This keeps you trading, but limits the emotional pressure that comes with seeing larger losses. Again, this is why I showed you how to manage the risk the way that I showed you with the different lot sizes, depending on your account, so you can expect and manage the drawdowns that come, the losses, the losing streaks, all that, because all that's going to happen no matter what. No matter what strategy you're using, it's going to happen. Lack of discipline in following your trading plan. A solid trading plan is your roadmap to success, but only if you follow it. Breaking your own rules because of emotional impulses will lead to inconsistent results. Discipline is the key to long-term profitability. Now, here's how to strengthen your discipline. Make your plan non-negotiable. Your trading plan is there for a reason. Treat it as a contract you must follow, no matter how tempting it is to deviate. This is why I told you guys, why I make trading for me very black and white, because it's literally like a contract. It's all the things are there to meet the contract, or they're not. If they're there, I take the trade, and if they're not there, I don't. Reward yourself for discipline. Every time you follow your plan, reward yourself, even if the trade results in a loss. This reinforces the behavior of discipline over immediate results. Use accountability partners. Share your trades and plan with a trusted trading peer or mentor who can help hold you accountable for sticking to your rules. This could help tremendously, and somebody that holds you accountable. If you don't have people that you talk to in trading, send me an email with the freaking thing, and I'll hold you accountable to your rules. Send me an email with your trading plan, and I'll make sure to hold you accountable. So if you need a partner, just send me the email with the stuff, and I'll be more than happy to help. So consistently searching for the next big thing, basically strategy hopping. One of the most damaging habits is consistently switching strategies in the search of the Holy Grail. This causes inconsistency as you never give a strategy the time it needs to prove its worth. Instead of mastering one approach, you're consistently restarting the learning curve. Guys, there is no Holy Grail. Okay? I don't care who says that they developed the Matrix. Okay? There is no Holy Grail of strategies. Every strategy is going to have its cons and pros. Every strategy is going to have its winners and losses. It doesn't matter what strategy you're using. There are hundreds of strategies that give you an edge. It just specifically, the strategy that you choose to trade has to fit you as an individual. You cannot just follow the blind because they said they found the Holy Grail of a strategy. So how to avoid strategy hopping. Commit to a testing period. Set a specific time frame, like 100 trades or 3 months, where you commit to one strategy without any changes. This will give you the data that you need to evaluate it properly. Define, don't abandon. Instead of ditching a strategy after a few losses, focus on refining it. Make small tweaks based on data, but don't throw it out unless you have substantial evidence it doesn't work. So commit to the testing period, get the data, and then refine. Okay? Don't abandon it after 3 months or after 100 trades. The 100 trades or the 3 months is basically getting you the data that you need so then you can refine it. Track your progress. Keep a journal to monitor how well you're following the strategy and its results. Over time, you'll build confidence in the system, reducing the urge to jump ship. Discipline in trading. What is it really? Discipline in trading is the ability to consistently follow your trading plan and stick to your rules, no matter what the market throws at you. How many traders confuse discipline with self-control during individual trades? But true discipline goes deeper. It's about creating routines, setting boundaries, and holding yourself accountable on a daily basis. So discipline involves following your rules even when it's tempting to deviate. Avoid overtrading by sticking to your setup criteria. Managing your risk consistently without changing your position size based on emotions. How it affects traders. Lack of discipline leads to inconsistent results. When traders don't follow their plan, they introduce randomness into their trading, making it difficult to measure progress or refine their strategy. Over time, undisciplined behavior erodes confidence, leading to frustration and even burnout. How to build discipline. Create routines. Develop a daily trading routine that includes pre-market analysis, post-trade reviews, regular breaks. Routines help keep you focused and reduce impulsive actions. Checklist. Before entering any trade, use a checklist to ensure it meets all of your setup criteria. This reinforces discipline and removes emotions from the decision-making process. This is why I tell you I use a list and keep it black and white. This is why. Set small and measurable goals. Focus on executing your plan perfectly for each trade rather than the outcome. This shifts your mindset to discipline and execution rather than profit and loss. Managing emotions. Emotions like fear, greed, and frustration are an inevitable part of trading. Successful traders don't eliminate emotions, they learn to manage them. Emotions impact decision making, often pushing traders to act impulsively or irrationally, leading to overtrading, revenge trading, or exiting positions too early. So, how it affects traders: fear can cause you to exit trades prematurely, avoiding potential profits. Greed may push you to hold on to winning trades for too long, risking a reversal. Frustration from a losing streak can lead to revenge trading, where you try to recoup losses with irrational trades. So, how to manage your emotions. Number one, use a trading journal for emotional triggers. Track not just your trades, but your emotional state during them. Over time, you'll identify patterns in how emotions affect your performance and can develop strategies to counter them. Predefined risk limits. By defining your risk before entering a trade, you remove the emotional attachment to the outcome. When you know exactly how much you're willing to lose, it becomes easier to manage your emotions. Guys, if you're entering a trade and you don't even know how much you're risking per trade, what are we doing? Every single trade, you should already know what you're risking, how much you're willing to risk, and how much you're willing to win. Take breaks. After a streak of losses or wins, take a break from the market. Emotional fatigue can cloud your judgment, so stepping away helps reset your mental clarity. Mindfulness techniques, again, techniques like deep breathing, meditation, or visualization can help you remain calm and focused, especially in high pressure situations. Process goals versus outcome goals. Most traders focus on outcome goals, such as hitting a certain profit target or avoiding losses. However, process goals are far more effective in ensuring long-term success. Process goals are actions you can control, like following your trading plan or sticking to risk management rules, while outcome goals are largely influenced by market conditions. How it affects traders. Focusing solely on outcome goals leads to emotional swings tied to wins and losses. Traders get discouraged when they don't hit their profit targets and may abandon their strategy prematurely. Conversely, progress goals keep traders focused on the execution of their plan rather than getting attached to the outcome. How to shift to process goals. Set daily process goals. Instead of setting a goal to make a certain amount of money each day, set goals like follow my trading plan exactly, or only take trades that meet all my requirements or criteria. Reward yourself for following the process. Shift your sense of satisfaction from hitting profit targets to following your plan. This reduces the emotional attachment to individual trades and builds consistency. Review your process, not just results. After each trading day, review how well you followed your process, regardless of whether you won or lost. Over time, this will make you more disciplined and confident trader. Guys, remember, man, success in trading comes down to how well you can manage your mindset. Stay disciplined and trust your process. Fear, impatience, emotional reactions are normal, but they must be managed if you want to succeed long term. By implementing these strategies, you'll not only master your emotions, but also ensure that your trading performance is driven by logic and consistency, not impulses. Mastering them is about more than just controlling your emotions. It's about understanding how your brain works and setting up systems that support consistent and rational decision making. Trading is about endurance and surviving the tough times and capitalizing on the good ones. When you shift your focus from short-term outcomes to mastering the process of trading, you build a foundation that will allow you to weather any market condition and thrive in the long run. Stay patient, disciplined, and self-aware, and you'll develop the mental toughness needed for sustained trading success. So guys, I hope you enjoyed this video. I hope it brought you a lot of value. These things in this video are going to help you in your trading career. I guarantee you that. Let me know in the comments below. Do you use any of these things that we talked about today in your own trading? Tell me in the comments, what things have you implemented yourself to try to get you over the hump and try to get you over through these psychological barriers that trading has given you, because it gives it to all of us. But anyways, guys, thank you so much and enjoy the rest of your trading week. Have a good one.